America now spends more on interest than on defense. Net interest in fiscal year 2025 was about $970 billion. National defense outlays were about $917 billion. For the first time in decades, debt costs more than empire. Historians have a name for this kind of moment. Some commentators call it Ferguson's law or the Ferguson point. The idea is simple. When a great power spends more service in debt than defending its empire, it has crossed a dangerous line. If you own stocks, bonds, real estate, crypto, a retirement account, or just live inside the dollar-based financial system, this is not only a Washington story, it is your story. Ferguson's law is the diagnosis. There is another concept that explains the disease. It is called Augustine's law. In 1979, Norman Augustine, later CEO of Lockheed Martin, noticed a brutal pattern in U.S. military procurement. The cost of tactical aircraft had been. He made a famous prediction. By 2054, the entire U.S. defense budget would be enough to buy only one tactical aircraft. Augustine joked that the jet would be shared by the Air Force and Navy 3.5 days each per week, with the leap day going to the Marines. It sounds like a joke, but in defense economics, Augustine's law is a serious concept, and reality has been moving that way. The F-35 program, for example, is often discussed as a multi-trillion-dollar life cycle cost case study. Analysts now argue the same logic applies not only to aircraft, but to air defense, missile defense, and modern precision weapons. That matters because some U.S. rivals now produce cheap drones and missiles at industrial scale, while America responds with some of the most expensive weapons ever built. That is the financial question behind the U.S.-Iran war. Great power competition today is about balance sheets and production. If America is near the Ferguson point and then fights a high-cost war against the cheapest producer of drones and missiles, is that a solution to imperial decline or an accelerator? To answer that, we start with the U.S. government's own balance sheet. Everyone has heard America's debt is huge, but most people do not know what that actually means. In March 2026, Washington released its consolidated financial statements for fiscal year 2025. As of September 30, the federal government held about its liabilities on the same balance sheet were about $47.78 trillion, nearly 8 times what the government owned. In plain English, the government owes nearly 8. Fortune called the report a declaration of insolvency, not a formal bankruptcy, but a fiscal warning, and argued the mainstream media barely noticed. Here is the confusing part. Most people hear the national debt is around 39 trillion. So why does the government's own statement show 47.78 trillion? Where did the extra $9 trillion come from? The answer, there are several ways to count U.S. debt. The first is the familiar one. Debt held through Treasury securities already issued. This is hard debt money Washington has borrowed by selling Treasury bills, notes, and bonds. That number is around 30. But there's a second number. It includes money the government has not borrowed yet, but is already legally promised to pay. That includes pensions, health benefits, and commitments to federal employees, retirees, and military personnel. Those obligations add about $15.5 trillion. They are not paid all at once, so the government need not borrow it all today. But legally, the obligation exists. That is why the consolidated statement puts total liabilities at roughly $47.78 trillion. Then there's a third, even bigger way to look at it. The report also discloses 7 5-year projections for Social Security and Medicare. The fiscal gap runs at 4.7% of GDP. Tens of balance sheet liabilities are about 1.6 times GDP. Under U.S. rules, social insurance promises are not. Why doesn't the balance sheet count all that as formal debt? Because Social Security is not legally the same as bond debt. Under U.S. law, Congress can change benefit formulas, raise retirement ages, or rewrite the rules. The Supreme Court ruled in 1960 that citizens have no, but politically, it is a different story. No politician wants to tell millions of voters their retirement promises So if someone says the US has 39 trillion in debt, that can be true. If someone says the real liability number is closer to 48 trillion, that can also be true. And if you count unfunded social insurance projections on top, the long horizon picture is even larger. All three of these framings can be defensible ways to describe the debt. Are the official numbers even reliable? In theory, yes. The financial statements are released by the U.S. Treasury, and they are supposed to be audited by the Government Accountability Office, the GAO. And for 28 consecutive years, the GAO has disclaimed an opinion on the federal government's consolidated financial statement. 28 years of disclaimers in a row. The biggest obstacle is the Department of Defense. The Pentagon reports trillions in assets operating across hundreds of bases, dozens of countries, and millions of people and contracts. Its accounting system is famously chaotic. The Pentagon has often struggled to provide proper documentation for large portions of its reported assets in plain English. Even the U.S. government has trouble proving exactly what it owns and where everything is. The DOD has never received a clean audit opinion. So the debt numbers are not as clean as they look. Another misunderstanding is who owns U.S. debt. Many imagine foreign governments hold most of it. That is not true. The biggest holders of U.S. debt are Americans. Government accounts, including Social Security and Medicare trust funds, hold trillions in special treasury securities. U.S. banks, pension funds, mutual funds, and foreign holders are smaller but still important. Japan, the UK, Luxembourg, and the Cayman Islands are often among the largest. The Cayman number usually reflects funds and special purpose vehicles domiciled there, not ordinary local capital. So the debt is both domestic and global. Domestic because Americans hold so much of it. Global because the dollar system turns U.S. treasuries into the foundation of world finance. That is why default fears matter. So far, the U.S. has never defaulted on treasury debt in the ordinary sense. So why does default keep coming up? Because 2026 is unusual. First, the debt stock is historically high. Second, the U.S. faces a massive maturity wall. The Treasury refinanced about 9.1 trillion of maturing debt in fiscal 2025. With this fiscal year's estimate, that partly reflects huge pandemic era debt issuance. And third, assume the United States is also at war. War magnifies every fiscal problem. Washington avoids technical default in a simple way. It issues new debt to pay off old debt. As long as investors trust the system and keep buying, the machine continues. But if confidence weakens, the machine starts to shake. To see why, we have to look at how the Treasury borrows. Treasury debt is sold through auctions, not like an art auction where the highest bidder wins. Before each auction, primary dealers trade securities that have not yet been issued. This when issue market helps estimate the yield investors will demand. The key reference point is the 1-0-year Treasury yield. It is often treated as the anchor of global asset pricing. Mortgage rates, corporate borrowing costs, stock valuations, and international capital flows are all connected to it. In a traditional crisis, especially a Middle East war, investors might rush into U.S. Treasuries as a safe haven. If buyers rush in, prices rise and yields fall. That makes it easier for the U.S. government to borrow at lower costs. But if investors react badly, the opposite happens. Worried about inflation, deficits, supply pressure, and geopolitical risk, some investors sell treasuries. When sellers dominate, prices fall and yields rise. By March 2026, the 1-0-year Treasury yield is around 4.4%, a mix of war risk, inflation, deficit anxiety, and supply pressure. Now, the strange part of Treasury auctions. Imagine the Treasury wants to borrow $10 billion. Major institutions submit bids. JP Morgan might ask for 4%. Goldman Sachs might ask for 4.1. Citi might ask for 4.2. The Treasury accepts bids from the lowest yield upward until fully sold. But after the auction clears, every winning bidder gets the same final yield, the highest accepted one. So if the clearing yield is 4.2%, even the bidder at 4 walks away with 4. At first glance, that sounds insane to people. Why would the Treasury reward everyone with the highest yield? Game theory. Before the late 1990s, auctions worked differently. Bid low, you got the lower yield you asked for, but bidders learned to avoid looking like fools. If JP Morgan bid 4 while another got 4.2, JP Morgan felt punished for bidding aggressively. So everyone bid higher. The uniform price auction solves this. If everyone gets the same final yield, bidders can bid lower to secure allocation. Friedman proposed it. The Treasury moved fully by 1990. But this works best when treasuries are trusted. If investors worry about inflation, war, deficits, and sustainability, they bid less aggressively. Yields rise. Something similar happened in the late 1970s. Iran's 1979 revolution helped trigger the second oil shock. That oil shock fed U.S. President Carter appointed Paul Volcker to lead the Federal Reserve. Volcker then crushed inflation by pushing interest rates above 20%. It was brutal. The U.S. economy suffered badly, but the bond market got the message. The Fed would defend the dollar's purchasing power, even if it meant forcing a recession. But that playbook is almost impossible to repeat today. With federal debt near 40 trillion, it crossed 39 trillion in March 2026. A 20% rate shock would be catastrophic. It could destroy not only inflation, but the debt structure itself. So in a modern crisis, one path is debt monetization. The central bank buys more government debt to stabilize the market. It may calm the treasury market in the short term, but it risks turning a fiscal problem into a dollar credibility crisis. Here is what those numbers really mean. Debt is not always the fatal issue. A government can carry huge debt if people trust it, inflation is controlled, and investors keep buying. The fatal issue is interest. In fiscal 2025, U.S. net interest outlays were about $970 billion. Defense outlays were about 917. Ferguson's framing isn't that a country collapses the next morning. It is that when debt service exceeds military spending, a great power loses the fiscal flexibility to maintain global dominance. Defense spending funds, aircraft carriers, bases, trade routes, alliances, deterrence, hard power, interest payments, fund bond holders. They do not build. When interest consumes the budget, the state faces a trap. In a crisis, it can cut domestic spending to fund war, risking backlash, or borrow more, pushing debt. And either way, the empire loses room to maneuver. But the Ferguson point is a model, not a prophecy, not collapse tomorrow. It means the financial structure becomes more fragile. War can temporarily change the arithmetic. The Pentagon first uses existing funds. If the war grows, the DoD asks Congress for supplement. If Congress approves a large war package, defense rises again. On paper, defense moves back above interest. Ferguson point is technically avoided. But the trick, the new money is borrowed. Borrowed money becomes new treasuries. New treasuries mean more interest later. The problem returns. A loop forms. Interest exceeds defense. This is why presidents want lower rates. From Trump's view, a Fed chair who refuses to cut looks like an obstacle. Every war needs a strategic reason. A financial reading. Iran runs the world's cheapest drone and missile lines. CSIS estimates a Shahed drone at about $35,000. A ballistic missile costs hundreds of thousands to a few million. The U.S. responds with extremely expensive interceptors, aircraft, and defense systems. This is where Augustine's law becomes. Augustine's law says U.S. weapons grow more complex and expensive over time. Cheap enemy weapons force America into expensive defense. Picture the first 100 hours, waves of drones and missiles. Public cost exchange analyses suggest U.S. and allied air defense spending could reach billions. Interception costs are often far higher than the incoming weapons. A conservative, if Iran's production stays intact, the cost curve gets brutal. Iran keeps producing cheap weapons. America keeps buying expensive interceptors. The bigger war bill simply adds to the national debt. That is the first financial truth of the war. America may need to neutralize Iran's cheap missile and drone production to preserve long-term power projection. Strategically, destroying centrifuges and preventing nuclear breakout would, but economically, destroying the cheap weapons line may be just as important. The goal, stop a long, exhausting exchange. Short-term costs rise, but Washington may cut off the long-term. That is the logic, not a proven claim about anyone's private intentions. But from the debt perspective, the paradox is obvious. Augustine's law says America's weapons get more expensive until the system strains. The Ferguson point says when interest exceeds defense, imperial power weakens. War temporarily pushes defense back above, but war is financed with more debt, and more debt means more interest. The war meant to preserve dominance may accelerate the conditions of decline. If still unfolding, no final verdict yet. Every day of war writes a new number onto the bill. That bill becomes treasury debt and is sold into the global market. That is the truth you find by following the money. Don't just watch the explosions, watch the balance sheet. A reminder, this is analysis and education, not financial advice. If you want more videos that follow the money, subscribe. And tell me in the comments, do you think the Ferguson point matters this cycle, or is this time different? We'll see you in the next one.